And just remind, it is recorded, so there is no issue if we want to. No, if I want to start saying again, so don't worry about that.
Yeah, sounds good.
Okay. 3, 2. Oh no, now I've lost my space again. I just wrote some magnificent notes on this. Oh, here. Hello and welcome to LiveSquawk's Market Talk. With the earnings season over halfway done, we thought it time to check in with our market expert, Christine Short, Head of Research, Global Corporate Events at Wall Street Horizon, a TMX company. But before we get into the detail, I just want to go over a quick disclaimer here. The content provided on this channel is for informational and educational purposes only. I'm not a licensed financial advisor, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performances are not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. And with that, I'd like to say hello to Christine. Hi, Christine.
Hi, thanks
How are
for
you?
having me, Harry. I'm
Oh,
doing well.
awesome. Also, always a pleasure as ever. There's lots to pour over in terms of corporate reports for this quarter. What's caught your eye over this quarter so far, and what do you see in the remainder of the season?
Yeah, so like you said, we're over halfway through. We're about 72% of S&P 500 companies have reported at this point. And the Q1 picture was great. We know that's backwards looking though, kind of a pre-tariff world there. But as far as Q1 results, yeah, we had, we're up to almost 13% bottom line growth for S&P 500 companies. That's almost double what was expected at the beginning of the season and the second consecutive quarter of double-digit earnings growth. So that's great. 76% of companies have beaten Wall Street analyst estimates thus far. That's right about the average. I think it's slightly below the more recent 1 and 5 year average, but above the 10-year average. So the beat rates are still pretty strong, and the amount by which they're beating is
That's
about eight and a
impressive,
half.
right? That's
Yeah,
impressive considering.
because when we spoke right around the time earnings season was kind of kicking off, the early reporters, so there were like maybe 17 or 20 names out the last time we spoke,
Right.
and they were not faring very well. And we thought, oh boy, is this like a bellwether of what's to come? The beat rate was only around 60 something percent. The names that were beating were only beating by 1 or 2%. Now that we're here with 72% of companies reporting, those that have beaten have done so by about 8.5%, and that's well above the 1 and 10-year averages. So
Mm.
we're actually coming in quite better than expected. But like I said, that's Q1, that's backwards looking. And what we always said we were looking for in commentary was what's happening in the second quarter, what's happening in the second half of the year, how
Mhm.
are these companies preparing for tariffs? And as expected, they're still quite cautious about what they're willing to say because we don't know. So many of these tariffs are still on pause. We haven't really gotten to see them in action. The IR teams have put together, the financials are together about, what the impact could be. But because there's still so much uncertainty out there of the scope of the tariffs, the timing, a lot of companies are not willing to roll that into guidance. You had Ford the other day saying they're suspending 2025 guidance. You even had Snapchat, so they're giving numbers of what the dollar impact would be. But Snapchat also, yanking got Q2 guidance due to an uncertain macro environment. You even had Tim Cook on the Apple call. He had questions around what Q2 numbers might look like as far as the impact of tariffs, which he did say for Q1 was around 900 million, but he said he wasn't willing. He couldn't give a number for Q2, so
Right.
it's hard to quantify. But you are seeing a lack of guidance or guidance that doesn't include tariffs, so it's sort of apples to oranges at this point. It's hard to piece together what Q2 and what the second half of the year looks like as far as corporate earnings.
Yeah, that's a good point, really. Again, with this 90-day period, it's kind of limbo, I guess, for everyone, the economy, for corporates as well as for the households as well. So until we get a bit more of an understanding of what happens, what deals are being done, what deals aren't being done. We were told by the administration, US administration, the White House, that we'd be seeing deals come through the door relatively quickly. And as such, I don't think that's been the case. I mean, India, I think maybe on the verge of one, if it gets over the line. We thought Japan was a done deal. That's still to be penned. And obviously the Eurozone and Canada, and there is still very, very much, there are more still waiting to be done than are actually being done, I guess. So, like you say,
Right.
I mean, for corporates, your forecast, it's a bit like central bankers, I guess. You have to, you play with the game you have, not the game you want, if you like, or, it's a bad analogy, but you see what I'm saying.
No, I see what you're saying, and that's what CEOs are saying. They're just saying, I can't predict the future. I think Tim Cook said that. I'm not going to try to predict the future. Like you said, the administration's been a little bit coy of what countries have come to the table or what might be close to crossing the finish line. China has not been. They've said, no, we're not. There are no deals on the table. We are not, currently in conversation. But yeah, we're just not sure at the end of the 90 days, what does that look like? Is there another pause? Do we go full throttle? And so you're not going to find a whole lot of CEOs taking the bait there and trying to guess what's going to happen and exerting energy on that. And, having investors, think one thing, they're not going to say it until they know it. And so that's certainly been the outcome of a lot of these earnings calls.
I just want to pick up on one of your articles here, Christine, the shortlist published by Wall Street Horizon. Big tech breathes life into Q1 earnings. We know, obviously, that the big tech firms have been a driver of sentiment and direction of late. Just want to get your thoughts on where we are with some of the companies that have reported and some that are still, like you mentioned Apple, but obviously we have other companies out there in that list of 7.
Yeah. The Mag 7 started reporting a couple weeks ago. We heard from Alphabet. It started off Alphabet, and then earlier last week on Wednesday, we had Meta and Microsoft, and it was painting pretty great picture, especially around the AI trade. So it sort of reignited the AI trade there. Earnings for the Q1 period were quite good for those 3 names, and then commentary looking forward was very positive. I think all of them traded upwards after their reports. You had Alphabet coming in with really strong, ad revenues, hefty investments into the development of their AI tools appeared to be paying off. They were asked about how, the changing macro environment might impact future results. And again, they weren't willing to say. They said it was too soon to know. I mean, the things I worried about with Alphabet were not so much the direct impact of tariffs, but indirect. So if the economy weakens, if consumers stop spending, does that mean businesses cut, their spending on Alphabet's AI tools? Do companies stop, putting ads through Google because they're trying to cut back? Google is usually the last area advertisers cut on, right? It is like the mega. That's if you're going to advertise, you're going to go to Google.
Exactly.
You're probably going to cut back in other areas first, like a Snapchat or smaller players. Although I think Snapchat ad spending was still quite good last quarter, and their outlook they were unwilling to give, but they still had some strength there. But yeah, Alphabet still came through great results, and then it continued into last week. We had Meta, same thing with ad revenues being quite good.
There was a bit of a surprise with Meta, I guess, wasn't there?
Yes, I agree. Everyone was kind of, I feel like the stock was trading a little lower ahead of earnings, but even the commentary was good. Mark Zuckerberg said they're well positioned to navigate the macroeconomic uncertainty. So, you're not always hearing these words of comfort. And so I think investors really latched onto that. And then Microsoft similarly beat on the top and bottom line. their Azure cloud. So cloud has just been exploding. The expectations for cloud growth going forward are, I think, growth of 34 to 35% in 2025. So kind of consistent with, or even a little bit higher than what they've been showing. What I was really focused on in these reports was not just Q1 growth or future expectations for growth, but it was the spending plans that really stood out, right? Because last quarter they reported CapEx spending for 2025 that was greater than investors were expecting, and now they've even upped the ante. So Microsoft increased their CapEx forecast for 2025 to about roughly 80 billion. So that's a lot of that going into the build out of their AI data centers. And then Meta, similarly, if you remember back in February, they gave a range of 60 to 65 billion for CapEx spending in 2025, and now they've raised it to 72 billion. So it's just a positive kind of take on the future and growth of AI. Like I said, both of those stocks were up, pretty massively after those reports. But the fact that they are continuing to invest in growth in the AI space, I think is a positive. Now, if we want to talk about a couple of the Mag 7 that reported on Thursday of last week, it sort of took a bit of a turn, right? You had Amazon and Apple, and the difference here is they sell physical products that are going to be hit by tariffs, right? So there's been the whole debacle with Amazon was going to give like a tariff. They're going to have like a little widget, right, on each product page to show this product now costs this much because of tariffs. And then he had the call of Trump. Jeff Bezos did, and they did away with that plan. But yeah, there's been a lot of talk about the increase of prices because a lot of things that you buy on Amazon are coming through China, and so the results there were not as rosy. They forecasted operating income for Q2 would be in the range of 13 billion to 17.5. That was below Wall Street's expectation for almost 18 billion. And Andy Jassy, he said it plainly. None of us know exactly where tariffs will settle or when. And then he said that future results are inherently unpredictable.
Okay.
So yes, that's and same with Apple, right? Like they're selling iPhones, they rely on getting pieces from China. Tim Cook said that expect an impact to the tune of 900 million, and again, declined to comment further as he didn't want to predict the future. So a couple different stories there within the megatech space. I wouldn't say those latter two were terrible reports, but it's just coming off of Alphabet and Meta and Microsoft results. It did take a bit of a different tone.
Yeah, I mean, just quickly on Apple. I mean, there is still that legal. Are they got a legal issue hanging over them at the EU? App Store concerns maybe playing on the mind there a little bit as well. But like you say, these are reflective of maybe where the households are as well. And again, it goes back to that the narrative about uncertainty, about where we are at. I think with the whole big picture on trade. I want to move in nicely on. I want to move to now tomorrow's FOMC meeting and see. Look, we're not looking for any change out of tomorrow from the FOMC and the Fed, but in terms of the messaging and what they're going to be looking for moving forward. Do you have any views on that and how it might affect the equity space?
Yeah, it's kind of tricky for the Fed, right? Because you've still got this very sticky inflation where, prices are higher, but we're starting to see weaker growth creep in, right? And we saw that in the latest GDP reading for Q1. GDP fell 0.3%. It was the first quarter for negative growth, since 2022. A lot of that had to do with the rush of imports. Everyone's trying to get things in before tariffs take place, right? Companies are trying to, stock things, and all of that's certainly at play. Like you said, no expectations for rate cuts tomorrow or in the June meeting. I think the first I saw for the CME Group's FedWatch tool was July. That's been the case for some time now. I think the general consensus has been the next rate cut would not be until July. And then how many rate cuts after that is always the question, right? In the second half of the year. We know there's a few things that the Fed looks for. Obviously, the PCE index. What I thought was interesting with our jobs numbers on Friday is that average hourly earnings rose to their slowest level since July of 2024. So that's something they look at is wage growth rose 3.8%. Chair Powell has said that wage growth of like 3 to 3.5% is consistent with the Fed's 2% inflation mandate. So I would expect that perhaps to be part of the post-meeting press conference tomorrow. They might mention the slower wage growth as a sign that the U.S. labor market is coming into a little bit of better balance with the need for without the need for job losses. Even though, Federal Chairman Powell has said that U.S. wage growth hasn't been a driver of inflation, but I still think last month's numbers are helpful
factor,
to
isn't
the
it?
Fed.
It's definitely a factor in.
It's certainly a factor, right? Because that's wage growth has been quite sticky. So, and that's still helpful to the Fed's longer run goal of price stability. So I'd expect there to be some mention of that. But again, yeah, they're in this situation where, we're still seeing quite high inflation and overall weaker growth. You've talked a bit about the consumer as well. We've seen this softening in consumer spending. Although there's been, Q1, I wouldn't look at so much for that because there's been this pull ahead of purchases, right? Especially large ticket purchases. We've seen that in autos. We've seen that in appliances. Everyone that knows they, might need to purchase a large ticket item in the near future has run out and done it because they're not sure what the impact of tariffs on that item is going to be and how much that will increase the price. So there was a little bit of that at play, but overall the consumer is weakening. So yeah, we will be looking out for comments tomorrow. Certainly no expectation of a rate cut. We'll wait to hear more about, is the Fed still in wait and see mode, and what are they looking for? Is that changing, and how they're going to deal with this issue of high inflation and potentially weaker growth?
Yeah, I mean, we are expecting maybe a change in the statement and the slight messaging here. So it'd be interesting to see, like you say, where they come at things from that perspective. Before we round up here, I wanted to talk about a little bit about the Hollywood situation and the Sunday announcement by President Trump around Hollywood and wanting to make 100%, putting 100% tariffs on filmmaking, US filmmaking.
Yes.
Is that something that we'll have to, again, that's going to be a longer term thing. We'll have to wait and see how that pans out, I guess, in time.
Yeah, I mean, he that was based on a conversation with John Voight or something. Is that what I saw this morning?
Yeah. Well,
Yeah.
yes, obviously it was it was something as important as that. And yeah, here we go. We're now onto a new. It's almost like attention. He's turning it, just something flies past the window, and he wants to turn attention to that now as well.
Right. I think the comments I had seen about it today is no one knew whether or not to take that seriously. Is that a real thing? Yeah, there's so many other things to worry about, but yeah, you're just not sure if that's something that he was serious about, and especially something as flippant as mentioning, it was a conversation with John Voight. I think he's one of Trump's Hollywood ambassadors. So yeah, I think there's other I would say more concrete things to focus on, but I have no idea how that one's going to play out. It feels like one of these other distractions, right? Like, what is, where did that come from, right?
Yeah, but I mean, there's a serious note in the likes of Netflix and how it may affect Netflix and maybe to a lesser degree Amazon, but some of these bigger platforms and their shows really down the line. But again, it's one we can look at, I think, because I think it's that'll probably run a bit longer than, or not, into the next earnings season. I want to finish off with just, I guess, a little nod to someone that's been around the whole of my career, and I guess yours as well. Warren Buffett has announced his retirement this week, and again, we're losing one of the greats in terms of financial markets and investors. And I just wondered if you had anything to say on his career and how sorely he'd be. I know I'll miss him because, as I said, he seems to have been that adult in the room over many a market turmoil and a market disturbance. Whenever there's been something out there, he's been the person he's the sage of Omaha for a reason. You know, he's been around a long time, and there's a lot of wisdom there. So we're going to miss someone of his sort of gravitas, I think, in the markets.
Yeah, I think we'll still hear from him. I hope so. At least he's
I
staying
do,
on as
yeah.
chairman. But yeah, my whole life, look, my grandpa's about his age. My grandpa was always very into investing. It's kind of how I became interested in finance, and it's just kind of cut from the same cloth. It's a certain generation. He was always very measured. You trusted him. He was honest, and it wasn't just because of his returns, like you said. It was just the way he spoke. He was very apolitical. He was very matter of fact. And he was brilliant, you know, and he was obsessed with investing. He did it because he was obsessed with it, right?
Yeah.
He, and as we discussed kind of before the call, is the way he would explain things. It was so easy, you know, it wasn't complicated. I think the average investor could really understand where he's coming from, you know, his just investing in the tried and true and what he knows, and it just always made sense. And the way that he was able to communicate that in a way that was so uncomplicated that you really stopped and think, oh yeah, you know, that makes sense to me. It wasn't over anyone's head.
Common
So
sense
yeah,
investing is the way I used to say it. Common sense investing is like you said, he made it sound so obvious. It was just like, well, why the hell didn't I think of that?
yes, and as
That's
I was
what I
saying
was.
too, I love just the little anecdotes about how he lived his life. You
Mm,
know, he never, he wasn't very materialistic. He never moved out of, you know, the house that he's always lived in Omaha. He wouldn't buy the Egg McMuffin from McDonald's if he had a bad day in the market. I
mm,
mean, what is that, $2, $3? You know, it was just that was his method, and he
yeah.
stuck to it, and it obviously worked very well for him. But yeah, I certainly hope we hear more from him, even as he steps down. I think we will, because now more than ever, you kind of need that steady, consistent voice. And so hopefully he's not going anywhere as far as just using his voice and
Mm.
continuing to talk about the markets. And I don't think he will, because he is obsessed with it. And maybe the day to day will be a little bit different, but we could certainly hear, you know, use his words of wisdom right now.
At 94, I can let him off. At,
Yeah, right. He can take a break.
at 94 years old, if he wants to have a day now and again, I'm going to let him. He's proved his worth. Yeah, and on that note, I'd like to say thank you, and hopefully we'll be around in another 50 odd years. And I don't think we should be doing this in 50 years' time. Let's be honest.
Yeah, we'll take a break then too. Yeah.
Yeah, we'll look at something else to do. But I'd love to get you back on again for the next quarterly earnings and discuss the topical matters then. But thank you very much, Christine. We'll push we'll push this out. We recorded this on the 6th of May, so a day before the FOMC, and we'll push it out later today, early tomorrow morning, anyway, ahead of FOMC. But we'll get you back on again for another one of these episodes, and very much appreciated as ever. Thank you, Christine.
Thank you so much, Harry. Always appreciate being on. And yes, early July when the banks report, we'll kind of take a look at Q2 and see what to expect for that.
We may actually get some movement on trade, possibly, hopefully.
Right. Well, right. Some of these pauses will be lifted, and we might